So good morning, everyone. Thanks for being here with us today. My name is Gustavo Perrotta. I'm the CEO and founder of Hamilton Global Opportunities. As previously mentioned, we are an investment holding company listed on Euronext Growth in France. We have just had the second year of listing last week, celebrated our second year of listing last week. We are not an ETF, we are not a SPAC, because very often we get this kind of question. So you are an ETF, you're a SPAC, you're a fund. No, we're a holding company, we're a stock, and we invest in late stage technologies in US and Israel primarily. So it's important to state what we don't do, in my humble opinion, because this will help to understand better our value proposition. So we don't invest in early stage, we don't invest in venture, we don't invest in seed, we don't invest in restructuring story. Simply putting, we invest in strong companies that are growing, have no technology risk, have a capable management team in place, and they potentially need some money in order to grow for the next 2 to 3 years. So our time horizon typically is between 3 to 4 years when we invest. And we would like to build something consistent, something solid, something that it's in place for the next few years to come. We call our business dynamic and transparent investment. Why dynamic and why transparent? First of all, the transparency and the credibility of the business, which is critical for us. We release unaudited accounts every 6 months. In June, we release audited accounts at the end of the year. Last week, we published the financial results for 2022. We moved from a loss of 284,000 euro in 21, which is essentially the loss created by the IPO operation in April 21, to a profit before tax of 1.7 million at the end of 2022. We reported €3.26 in EPS, and our capital invested is now 90% of what we originally raised during the IPO. It's dynamic because we try to build a very dynamic, ongoing, and constructive relationship with our investee companies before deciding to invest with them. At the end of the day, we invest in people. It goes without saying that we take shares, we take convertibles, we take semi-equity into businesses, but it's the relationship at the core of the value proposition that we built during the course of the years with these companies before deciding to pull the trigger and eventually invest with them. So this is a very relevant part of our business process. I want to talk a little bit about my colleagues. Today, we are representing the company along with my colleague, Gavin Alexander, who is the director of the business and chief risk officer. So it's a small boutique. It's 6 of us. Combined, we have 150 years of experience. We have been lucky enough, myself in particular, to have this journey with somebody like Peter Middleton. Sir Peter is the former chairman of Barclays Bank. He's the former chairman of Marshall McLennan. He has been a mentor, a partner, a very important part of our journey, a very important part of our business. Myself, as a background, I was an auditor with Arthur Andersen. I had a small stop at Morgan Stanley, and I spent 15 years of my career at Credit Suisse. During the year 2000, I was lucky enough to work with the technology team at the time run by Frank Patron, who moved from Deutsche Bank to Credit Suisse. So I cemented interesting relationship with the tech team that was part of the success of the Credit Suisse in the year 2000. And since then, we kept in touch with several of my former colleagues who, like me, left the bank and created their own boutiques in the Silicon Valley, Boston, and New York area. And this is how we actually create our pipeline, our origination, and our opportunities to get in touch with interesting businesses in the USA. Gavin will introduce himself.
So just briefly, very similar past. I was 15 years JP Morgan, 2 of which were in Germany, then Bank of America, Merrill Lynch, and then ultimately the senior at Credit Suisse. Slightly different sector backgrounds at Gustavo and Merrill Lynch. So it's a complementarity rather than.
Then we have Andrew Wynn, who is a former portfolio manager. Some of our companies in our portfolio inevitably are going to go public. So we wanted to have somebody with a portfolio management experience to guide us on how to do and what to do and when to do with the companies who become public. Hari Enger has a strong private equity consulting background, international from Indian background. And Michael Brendel is our associate who does a lot of work in terms of due diligence, number crunching, and analysis. Origination and execution clearly are extremely important for all of us. But before talking about this, I think we should be spending 2 minutes about the previous journey that led us to become a public entity. When I left Credit Suisse in 2009 with Peter Middleton, we set up the company, and we ran the company as a private business for almost 12 years. At that time, we essentially pushed the model, which is called, the club deal model. So we didn't have any vehicles in place in terms of capital raise. We didn't have any fund. We didn't have any capital committed. But there was a lot of activity developed in terms of business development, due diligence, analysis, research, vetting. And when we had the opportunity to invest in something really unique, then we had to also raise the capital. So it was kind of inefficient from a time-consuming standpoint. So we decided after 12 years to make it a little bit more efficient, and we decided to go public and raising the capital from institutional clients. When we went public, we essentially did 3 good things. We moved the company from the private sector to the public market. We institutionalized the business because we have today 5 strong institutional shareholders next to us: mutual funds, pension funds, endowments, private banks. And we created something which is highly scalable, considering the fact that today we are only 20 million euro market cap, but via a simple private placement, when we convince new shareholders to come on board, we can scale the business to the next level. Our objective is to reach 100 million as a first target. This will allow us to have a portfolio of roughly 8, 10, 12 companies. So we still want to have a very concentrated portfolio so that each one of us can follow in a very proper way 2 to 3 companies per person. So we talked about the history of the business. The origination comes through our own network. It comes through the help of some of our consultants that we use in both US and Israel. We have decided to focus on those 2 geographic areas for simple reasons. A, because de facto are the technology lands. 2, because of the liquidity of the market. 3, because of the opportunities that arise in this sector. And 4, because of this unique relationships model that has driven our business for the last 15 years. We like to have direct access into businesses before deciding to invest, simply because we really need to understand who we are giving the money to. As you might appreciate, we don't send money to a company, we send money to a management team. So we really need to understand who they are and how they think and what the plan is. We invest with enablers, we invest with innovators, we invest in technology, we invest in people who can execute properly and ideally can take advantage of our money in order to develop further the business plan. We want to have this direct access, and we want to have people who can execute properly or in line with our expectations. So again, very simply putting, we invest in tech, fintech, and medtech. We invest at a later stage. This is very important for us because we assume that there is a much higher protection of the capital in principle. What I mean by that is that investing in venture early stage, we assume a risk of 90-95% death rate. When you invest at a later stage, clearly there is already a sum of the parts, a value creation, a business, which even if it doesn't perform in line with the expectation, could potentially lose something in the region of 10, 20, 30, 40%. It might still go to 0, but it's much more difficult than investing with an early stage company. So for us, it's imperative to try to protect as much as we can the capital and build something for the long run where we see consistent return and asymmetric return vis-a-vis what happens in the market space. The exit typically happens via either an IPO or a trade sale. And as I mentioned before, we do expect the exit to happen in a period of time between 3 to 4 years. So clearly we are not there for the long run. When we invest, we don't envisage, think, or hope that our investment is sitting for 7, 8, 9 years, so we can make 10, 15, 20 times the money. We are not in that business. We are in the business of pushing, sustaining, and supporting management teams who have done already extremely well, and they are toward the late tail of their journey, and potentially the exit occurs as quickly as we all hope. Origination, due diligence, transaction structure, deal execution, it's clearly in our codes, and you know extremely well what it entitles in terms of time. We tend to spend a lot of time with our companies. We love to meet companies at early stage. We are very open and direct with them. We tell them, if you're looking for money right now, we're not the guys that you should be talking to, but nevertheless talk to us. Because if you develop your business, if you prove your concept, if you become something different and bigger within the next 2 to 3 to 4 years, it will be phenomenal for us to have had the chance to meet you 3 years before, so that now we know inside out your business, your strategy, your vision, and your execution plan. So we see companies, as you can imagine, you know, on a weekly basis, and I'm extremely proud to say that, especially thanks to Mr. No, sitting on my left side, we have been pushing away lots of stuff that during the last 6, 7, 8, 9 months, when we were living a different kind of era, was coming to our desk at a multi-billion-dollar valuation, going for $1 trillion or 5 trillion or 10 trillion. So that is not the business we are in. We are very, very focused on fundamentals businesses, right valuations, good people, great and capable managers able to deliver and to perform in line with the expectations. As I mentioned before, we don't take early risk for reasons already explained. We like to think that, you know, once there is no technology risk, when there is no sales risk, when there is no execution risk, the only thing left is that we are toward the end of the journey, and we are there to support the companies in any way, shape, or form. Interesting to say that, to give you real examples, we currently have 3 portfolio companies, 2 fintech in the US, 1 nanotechnology company in Israel. 1 nanotech company has filed with the SEC for an IPO on NASDAQ. 1 of the 2 fintech has done the same, again, in NASDAQ. We have been supporting their operations up until the day that they shut down the dialogue because of obvious reasons, because of the regulation. And with our support, we have been providing a lot of help during the process, moving toward the potential IPO. This shows you a little bit of what's happening in the space into which we are operating. So private equity net asset value growth has by far outpaced the market cap of the listed companies. On the right side, you see the trajectory of the private growth and the private capital. People talk about 10, 11, 13 billions. In our humble opinion, we don't have a real number to put in front of these slides, but this is just estimates coming from PitchBook. It is clear to us that this is now an asset class to stay. So it's not a trade, it's not something, it's not a fashion that is going to disappear. It's a solid asset class that would be here, would stay here, will grow inevitably during the course of the years. And what we are offering to our shareholders is access to the private market by a public entity. This is the reason why through our shareholders, we have the entire value chain. We have a pension fund who tick the boxes by investing into a public stock. We have mutual funds, we have private banks, we have an endowments. So from a technical standpoint, we have created an instrument which allows you as shareholders or potential shareholders of the future to invest into a public entity who has exposure into the NASDAQ of the future. We'd like to think that we have a 2 to 3 years lag versus what happens in the market going forward. I'm proud to say and happy to say, as a former auditor, that we have also put in place a very solid, strong, well-thought risk management process in place. And without any additional comments, I will leave to the expert to explain what it means.
So, although we're an investment holding company, we actually act as a fund through our investment process. So we have, although we're a company, we're regulated as a fund. So we have an alternative investment fund manager, which is regulated by the Central Bank of Ireland, and our advisory company is regulated by the FCA. We also have a sub-investment manager of the AFIM, who's also regulated by the FCA. So we have a very robust initial approval process where our investment committee proposes to the board then approves taking the investment further through the chain. we have to make sure that it's signed up by the AFIM, that it fits within our risk policy. And then go to an external investment committee with the third-party FCA regulated entity. Subject to those two approvals, the AFIM and the external investment committee, we go back to our investment committee, then puts it forward to the board, but then eventually signs up. That sounds very laborious, but it means we have a very clear and documented process, and we have third-party eyes that look at the process and every single investment that we make. And in doing that, we obviously should be violating the requirements. Then once we made the investment, we have the risk policy remains in place with the AFIM. As a listed company, we have to publish our accounts semi-annual news. So we publish unaudited accounts every June and audited accounts for December every year. And going through the audit process, the evaluation is put together by the evaluation committee, and then audited and checked by the auditors. And so we have quite a very robust and very transparent process. But it ultimately is put into a public domain because once they go through the audit process and evaluations are very clearly appear in our accounts.
You want to talk about the comps?
Well, let's just start. So we don't have that many comps, direct comps. Obviously, there are a number of listed investment vehicles. Quite a few of them are in the UK. There's a large market of investment trusts in the UK. But each of the comps tends to focus on a particular area. So the first one focuses on technology, particularly, but in startups. Augmentum, generally in Europe, on Series A. Same again for the next one. And VEF, which is probably the closest in terms of structure, it actually focuses on technology and emerging markets. So we sort of complete the set, because we are the only listed entity that currently focuses on private tech investments in the US and Israel. So we can kind of complement the others because we don't compete with them. They have similar models. However, very proud to say we outperformed them so far. We continue to hope to aim to do so going forward.
Thank you very much. Very briefly on our portfolio companies, as I mentioned before, there are 3 names in our portfolio. The first investment is dated 2021. It's a company called Exos Financial. It's a financial technology company launched and created by Brady Dugan, the former CEO of Credit Suisse. It's a company into which he personally invested $80 million. It's a tech structure created on top of artificial intelligence data analytics, able to disrupt, if you want, the financial sector, which is $5.3 trillion. This has been Brady's mantra since he was a CEO of Credit Suisse. He has been asking the board for $100 million in 2 years of time in order to create a new technology, much more efficient, much more scalable, much more advanced. And he was given billions of dollars to put patch on a legacy technology, which has eventually created some other issues. Business that it's in its phase of development, and it's the first business that we invested into, based in New York. The second one is a company called Miami International Holding. It's one of the last remaining private exchange in the USA. It's a company which has diversified its asset base by diversifying and acquiring assets such as the Bermuda Stock Exchange, which regulates the insurance market, the Minneapolis Grain Exchange, developing so the exposure in the commodity sector, and recently has reacquired from FTX the sale of LedgerX, which was done in the previous months at quite an interesting price, actually. Gauzy is our last investment, probably one of the most interesting companies in the nanotechnology space. International company, although based in Israel, they have operations in the US, in France, and here in Germany, in south of Stuttgart. In the liquid crystal space, it's a company which develops its technology and sells the technology in the aerospace and the automotive sector. They have created the roof of the last SUV of Ferrari Purosangue. They have recently signed a deal for the new series of the BMW. Yesterday, they came out with an announcement with a new deal with Air France. So So this is one of the most innovative company around the world, which we are very close to. And I'm glad to say that for Gauzy and for Miami International Holding, unfortunately or fortunately, we don't have any more information from several months ago, because both of them have filed with the SEC for a potential IPO on the Nasdaq. So theoretically, any day is good for us to receive interesting information on those two companies. I mentioned before our financial results. The stock is up roughly 10% since the IPO. Our capital employed is roughly 89%. So we are pretty much done, including the 3 deals that I mentioned before. We moved from a loss to a profit. And I'm glad to see that the stock has had a resilient performance even during the probably most difficult year of the last 10. Losing only 0.41% during the year. Few information about the stock, but mainly the message I would like to leave you with before we open up to Q&A is that it's thanks to our history, it's thanks to our track record, it's thanks to our previous lives that we have created such an interesting group of people who can participate into this venture with interesting background, different CVs, different track records. We have learned from our mistakes in our previous lives. We were investors in the early stage. We started realizing that we put a lot of money into venture capital, a lot of money into the growth deals. There was a massive loss on the early stage. There was interesting returns on the late stage. This is the reason why we decided to abandon that kind of business and focus on the one that, in our opinion, from a risk-reward standpoint, can offer asymmetric returns vis-a-vis what the market can offer with other instruments and other ideas. We are listed on Euronext Growth in Paris. We trade in euro, and this is our first exposure to the German market. And I would like to thank Michael, Lexa, and GBC for inviting us today and introducing our business to you all.